next guest says an economic slowdown and inflation meaningfully above the Fed's target could potentially put the U.S. into stagflation. Joining us right now is Oksana Aronov, who is the head of market strategy and alternative fixed income at JPMorgan Asset Management. And Oksana, that is not something anybody wants to hear, this idea of stagflation. We have so many people who are thinking, OK, it's going to be one more Fed rate hike and then they're done. And by the end of this year, we're going to see Fed cuts. You don't think that's the case?
I think every kind of investor tries to rhyme their worldview with whatever data they can find. And there's plenty of data to support either view. And I think that's really just the point, is that it's a much more nuanced discussion than the reductive narrative that's dominating today, which is that we're heading for a slowdown, and depending on who you're listening to, a severe one or a milder one, but the Fed is going to cut hundreds of basis points, and therefore you should own interest rate risk here, or duration, lots of duration here. And that, of course, conveniently ignores the fact that inflation is still uncomfortably high, not just here in the U.S., but also across the pond. Europe is still running very, very high inflation levels. Their core actually moved up in March, and the U.K. is at 10.3%, which is a record, frankly, for them. So inflation remains very much an issue, and we know that as goes inflation, so goes the correlation between stocks and bonds, meaning when inflation is high, that correlation is positive because the Fed's hands are tied to deliver the kinds of cuts that make bonds really that sort of port in the storm for portfolios. So I think, yes, we could potentially be headed for a stagflationary scenario, and that's not really a narrative that's out there, and I think investors have to contend with it.
Is that your most likely base cases, or is that just something that there's a risk of?
That is something that there is a risk of. And if we are in the business of building portfolios that can withstand a variety of scenarios, it's certainly one that we have to think about, as opposed to just kind of resort to old ways, which is that, we're going back to zero. And that seems to be kind of the preferred outcome and the hope that is dominating strategies out there. And today, it's really hard to point, frankly, to any data point and say, this is recession right here, right? There are some trends, but even when we look at the jobs number that, came out weaker yesterday and has been on a weaker trend for 8 months, but the unemployment rate has actually fallen over that period of time. So levels really matter. And it's going to be a lot more difficult to go from 5% to 2% on inflation than it has been to go from 8 to 5. And as long as inflation remains meaningfully above the Fed's target, the Fed funds rate is going to remain meaningfully above zero. And that means, higher for longer. And what does that world really feel like? We haven't really lived in that world for so long. Government balance sheets, corporate balance sheets, everything will have to adjust to the reality of higher for longer.
So how are you telling people to adjust their portfolios? What do you do?
Today, it's really, I know that holding liquidity is kind of this four-letter word almost in investing, but there's really no shame in holding liquidity because you are earning 5% at the very short end of the curve, and then attacking opportunities as they arise. We just had an opportunity in the banking sector, right, on the back of all of the stress, and there was an opportunity to pick up the AT1s if you weren't already in them, if you were an opportunistic investor. And the same thing with investment-grade floating paper, for example, that also winded out on the banking stress. So and this was really just one of the many unpleasant surprises that we are going to go through as the effects of this hiking policy will continue to take root. Because remember, yes, we're closer to the end of the hiking cycle than we are to the beginning. I think we can all agree on that. But we're just at the very start of what that means, what the effects that will have on the economy and on markets. And investors should preserve optionality here and beware of consensus, which is pushing them into the market, and it's too early for fixed income.
So you're saying T-bills?
T-bills, so the very front end of the curve, essentially cash yields are 5% and moving higher, right? We expect another hike from the Fed. Why would we extend here and hope for hundreds of basis points of fall in the Fed funds rate, right? That's the only reason to buy a 10-year or something farther out on the curve. And there will be great opportunities as credit does dislocate as this year goes on, because frankly, irrespective of whether the credit dislocating because the risk-free rate is moving up because inflation is more resilient, or it's dislocating because there is a recession. But that dislocation is coming. Be prepared to take advantage of it.
Oksana, thank you.
Thank you.